Hi everyone, it's Bini here. Thanks for joining the session. All right, today I'll be learn about derivative trading, your first step towards a professional trading career. Okay, before we start, let's take a look at the disclaimer here. Okay, the session is educational. It's not meant as any buy or sell advice. So please take about 10 seconds to read through the disclaimer. All right. Today's agenda. Before I move on to today's agenda, the content of today's presentation is really to give you a basic, all right, the fundamental idea into what derivative trading is about. Okay, with the emphasis into SIMSCI, which is to trade into the Singapore Index Futures. Okay, so the first part, I'll be talking about the evolution of futures trading, meaning, for example, if we have equities, we have, for example, other instruments, then what futures trading is all about, and the basic of futures trading. All this terminology that you might find a little bit overwhelming, I'm just going to take it bit by bit and explain to you in a way that you can understand. All right. Specifically, we will be using the SGX MSCI Singapore Index Futures. That's the SIMSCI futures. And as an example, I will talk also a little bit about the single stock futures, okay, SSF. And some of you might be into equities trading. I believe that many of you are. So we will be talking about how to use SIMSCI as a hedge to your existing stock portfolio. Lastly, to round it off, what are some of the methods that you might want to explore? All right, if you are trading into the futures, again, that this method will give you an overview. It gives you a background, all right, into some of the possible things that you can explore in the future, or you might be interested in certain areas and you want to take other SGX Academy courses. Okay, so I'll be talking about swing trading in particular, all right, price action, divergence, and volatility trading. All right, okay, that's myself. I'm not sure whether these look like me right now, but I've been training for SGX Academy for a while already. Before that, or rather currently as well, I'm also training for institutional and retail clients, mainly overseas clients. I also help my clients design automated quantitative trading systems, so involved in system design. I'm also into equities, forex, commodities. I basically trade into a handful of products, and specifically for derivative, I'm doing SIMSCI and the indexes, all right, and as well as the metals and oil. Okay, whatever that's really move. Okay, and if it can move a lot, that's really exciting for me. All right. Okay, now let's talk about the evolution into futures trading. Okay, evolution into futures trading. Well, what's a futures contract and why is it called futures contract? Let me just read out the definition to you. Okay, a futures contract is a contract between a buyer and seller. So we're going to have the left side like a seller and the right side a buyer. Okay, so both of them, they decided to transact on a product. Okay, so the seller want to sell a product, the buyer want to buy something, all right, a product. Okay, so what they do is that they agree on a product that they want to transact, they negotiate. Okay, they negotiate a deal, all right, and what are the deals that they negotiated? They agree on a certain price they want to purchase, all right, and they agree to have that particular item or product or raw material, whatever it is, to be delivered at a future date. Okay, because it's being delivered at a future date, then it's called like a futures contract. It's not now, but in the future. Okay, so what would be the content of the deal? For example, we're gonna have the seller. Let's imagine the seller is selling something, all right, and probably, maybe, perhaps the seller is a farmer, okay, and he is farming oranges, all right. The buyer, she is making orange juice, okay, so she needs to buy oranges from the farmer, who is the seller, all right, to buy oranges to make orange juice. Okay, so therefore the buyer agreed with the seller to make a deal. Okay, so what's the deal about? There are certain components in this deal. For example, the buyer agreed to buy 1000 kg of raw material. In this case, for example, the raw material will be oranges, all right, at $1 per kg. So that's the definition of this deal in this particular contract, all right. Then if the deal is being made, then what will the seller do? Okay, the seller will agree, all right, the seller agree to supply 1000 kg of raw material, meaning that the seller agreed to grow 1000 kg of oranges, for example, and to sell to the buyer. All right. Now, however, the deal has been made already. That means the deal has been made earlier. All right. The deal has already been made on the 4th of August. However, both of them agree that the transaction, the actual delivery of that particular raw material, which is the oranges, will be only delivered. All right. The transaction will only take place. The oranges will only be delivered on a future date, which will be, for example, on the 28th of October. So right now, on the 16th of September, the deal has been made earlier, all right? But they agree on the terms and conditions, on the transaction details, but that actual delivery, the actual transaction, will only take place at a future date. Okay, so basically, a futures contract will be a contract between a buyer, seller of a product. The product will be oranges, and an agreed price. Okay, they agree on $1 per kg. All right, to deliver 1000 kg of oranges at which date? At a future date, which will be on the 28th of October. All right. Now, why do they want to do that? Okay, why does the buyer, all right, they agree to buy the oranges at the current price but only have it delivered later date? Okay, that's because the buyer is trying to hedge the buyer's risk. Okay, what kind of risk can the buyers have? Okay, the buyer might be anticipating, or the buyer might foresee that the future price of that oranges of oranges can go up. Now, go up probably because that they have certain special information, like the weather condition is going to be bad, all right? So the supply of oranges will be going down. Therefore, the buyer decided that, hey, I want to lock in that deal right now at this particular price for that quantity, to be assured that on the future date, the buyer will have oranges to make orange juice. Okay, so in terms of the role of the buyers to agree to that futures contract, the buyers, they are trying to hedge their risk. At the end of the delivery date, all right, then what happened is that the seller will have to deliver the product and the buyer will take the product. Okay. All right, now, then what happened to the seller? Why is it that the seller wants to sell oranges to the buyer? Why is it that they agree to lock in at the current price? Because then the seller, the farmer, will also be hedging their own risk as well. Okay, what kind of risk? Perhaps that the farmer, all right, knows that there will be oversupply of raw material. All right, then that oversupply of raw material might lead to a drop in price. Okay, perhaps that the seller knows that, in fact, there's many farmers coming out with lots of oranges in 2 months later. So the seller agreed that, hey, I want to lock in that higher price now. Okay, so in fact, the seller, they are also trying to hedge their risk as well. So in the futures contract, both of them will be having the physical delivery, all right, but both of them agree to a certain condition because they are both trying to hedge their risk. Okay, now then with that evolution, it moved to the modern days. Okay, modern days where we are trading the futures contract. All right, between the current day, which is on the 16th of September, or between the date that make the deal, which will be 4th of August, that's a month ago, right? Many things can happen, all right, between the date of the deal that's made until the date that's being delivered. Right, so what can be done? Maybe that's going to be a typhoon, or maybe that the prices of oranges is going to move up and down. That becomes a transaction, all right, opportunity. If you have opportunity, then there could be profit to be made. So people develop the futures contract and we trade that. Okay, although that we, all right, myself, I don't have oranges. Okay, but that doesn't matter. Before the physical delivery, I can be trading up and down. all right? And in the modern days, you can go for what we call a cash settlement. That means that you don't need to have products. You can adopt, right, cash settlement and no physical delivery if you were to trade certain types of futures. So therefore, broadly, there are two types of futures. One will be the commodity futures. The second broad category will be the financial futures. Okay, now what's the commodity futures? Basically anything that is used by the world to I think that is everything that's used by the world to make any product, right, can be traded as futures. Okay, so just to give you an example, you can trade the precious metals, the gold, the silver. You can trade the base metal, copper, lead, tin. You can trade agricultural products, soy, corn, sugar, right, and energy. For example, the oil, all right, and natural gas. And you can even trade livestock, pork bellies, and you can trade oranges as well. And you can trade orange juice as well. Okay, so that's not a joke when I give oranges and orange juice as an example. Okay, now for the financial futures, this category will belong to the cash settlement. That means that at the end of the day, you don't need to deliver a SIMSCI contract to the other party. All right, so we will settle the profit and loss via money. All right, cash. All right, so we can trade into the index futures like SIMSCI, which is based on the Singapore index, or the single stock futures like into the DBS or Wilmar futures. All right, the currency futures, for example, if you are bearish on dollar, all right, then you can trade into the currency futures, and in fact the interest rate or treasuries futures, and as well as there are tons of indexes, indexes futures that you can trade. For example, the Dow Jones, all right, the S&P, and recently moving very well, the tech, all right, the Nasdaq. Okay, so that can be traded as a futures contract. Now, then the problem, I mean, I wouldn't say it's problem, but a lot of people, right, when they engage into futures trading, there will be many things that they need to know, especially that, oh yeah, you need to have a maintenance margin, you need to have margin, you need to have all this and that. Okay, and it's not difficult to understand once I get through with you on all this terminology. Number one, just to remember, the futures contract is exchange traded. Okay, now what is exchange traded here? It means that the exchange guarantees that the contract will be honored. All right, thus, again, very important, eliminates counterparty risks. All right, every exchange traded futures is centrally cleared. This means that when a futures contract is bought or sold, the exchange becomes the buyer to every seller, the seller to every buyer. This will reduce the credit risk associated with the default of a single buyer or seller. All right, and I think that there's a lot of there's a lot of questions asking me what's the difference between the futures versus a CFD contract for difference. I think that this is the greatest advantage of trading futures, because then if you are clearing, if the futures are cleared with the exchange, then it means that it greatly reduces the counterparty risk. Okay, if you are trading into the contract for difference, the CFDs, then your counterparty risk lies with the risk of the person, of the company that you are dealing with. So for example, if you are dealing with company A and the company A becomes financially unstable, then that becomes a counterparty risk, okay, of that contract that you are dealing with, or that derivative product that you're dealing with. Okay, now when you talk about the specifications of each contract, all right, so the specification will be standardized, meaning that if you are trading into the gold futures, then they will standardize in terms of the delivery. All right, for example, you're going to deliver 1,000 kilogram or certain tons of gold. All right, if there should be physical delivery, or we are trading into the financials, then they will talk about what is the notional value, all right, of this particular contract. Okay, so everything will be standardized in terms of the specs. There will be a contract month or the delivery month of the futures contract, and I'm going to use the SIMSCI as an example here. All right, so if you take a look at the right hand side, so you're going to see that the SGX MSCI Singapore, then we have the July 2020, and right now we have the September contract. And when you want to roll over, move forward to the next month, when it hits into October, then you can trade into the October contract. Thus, because each contract will have a delivery month, which means that there will be expiry, all right, in terms of each contract. All right, so I will tackle the expiry later because they expire. Then upon expiry, then we can go into settlement. All right, so the settlement can be physical or cash. And I'll be using the SIMSCI. So all along, all right, the example will be talking about the cash settlement. Okay, now let's talk about the advantages of why one would want to consider trading into the futures contract. The futures contract can be traded in either direction, meaning that, for example, if you think that in the future it's going to be bullish, prices going to move up, then you want to long a contract. Okay, you want to go long. Okay, so long means that in the future you think that in the future it's going to go, price is going to go up. So you decided to long the SIMSCI contract, and when you long, you always will buy at the higher price. So when you transact, right? When you transact, if you decided to go long, to buy, you will be buying at a higher price, thus the ask price. Okay, so this is the ask price here. Now, in the future, if prices is to move up, all right, you will make a profit if the future prices, all right, they are higher than the price that you bought. Okay, now, however, if you think that in the future, right, things is going to be bearish, then you want to go short. Okay, short means you sell now. Okay, and just remember one thing, as trader, as someone in the market, and it's fair as well, right? You are always worse off. So you always buy at a high price, you always sell at the low price. Okay, so you will be transacting at the bid side. So the bid side here, if you are going short, okay, and you will make a profit if the future price is lower than your transacted price. Okay, now one question that you might have is that, hey, look, I don't own anything. All right, how can I sell when I don't own anything? Right, so because this is a derivative product, it doesn't require you to to own something. All right, basically you get profit from the difference between the price that you transacted versus the ending price, which is the price that you close your particular contract. Okay, now therefore the difference between the bid and ask, that would be your spread. Essentially, your spread will be your cost of your trading. Okay, so the lower the spread, the better it will be for you. The higher the spread, it means the cost of trading will be higher. Of course, that when you trade in the futures, then there will be other costs like clearance fees, etc., etc. Okay, so but essentially the basic will be, the spread would be your cost of trading. Okay, now in terms of the contract specifications, different contract will have different currency on transaction. Therefore, if you are trading into the SIMSCI futures, that would be under SGD, Sing dollar. If you are doing, for example, the oil, all right, or the US indexes, they will be under USD. Okay, the contract size is also fixed. So for the SIMSCI, it will be a multiplier, meaning that it's a fixed value that the exchange plays on that contract, and that will be $100 times the index. Okay, meaning that, for example, if the current index is 295, okay, so the contract size of your SIMSCI futures will be 100 times 295, that's 29,500. Okay. Right, now the SIMSCI, for example, every tick is 0.05. Okay, we call that one tick. Usually when it moves, we call that one tick, and one tick at this point, all right, for the SIMSCI will be $5. This means that if you are taking at the bid and the ask price here, the spread here, because that's 0.05, right, that would be $5. So 1 point movement, for example, if SIMSCI is to move up from 295 to 296, that would be equivalent to $100 if you were to transact one contract. So for example, if you transact 5 contracts, 5 times 100, a 1 point movement on a 5 contract, that would be $500. All right. Now, during the March period this year, you heard probably over the news that the U.S. indexes there's plenty of limit up, limit down. All right, basically limit down. Okay, what's that? That's because that in the futures trading there will be a price limit, which means that the maximum price range permitted for futures contract in each trading session. All right, now when price reaches any of this predefined limits, then the market will go limit up, limit down. That means that they will take a pause, all right, for X time, and then they will cool down, sort of to cool down, and then they will resume trading again. And these price limits are recalculated daily, and different contracts will have different limit rules, okay? And you usually get hit by this limit, all right, when the market is really very, very volatile. That means that the market really move a fair bit, all right? Okay, now just now we talk about the advantages of trading into the futures contract. You can easily go long, go short. Now, one of the key things about trading the futures contract is that it is a leverage instrument. All right, don't be scared when we use a leverage, because it's just like something bombastic, but it's a very common, it's always when we trade futures, right? It's always leverage. It means that, for example, you use a small amount of money, all right, to trade a larger amount of contract. Okay, thus, because it's a leverage instrument, you will need to put some form of a collateral, all right? That's collateral resemble like deposit, and we call this amount of money, which is your collateral, as your margin. Okay, so therefore, when you start trading with the futures contract, we need to know, for example, in each of the different instrument that you are trading, all right, what is the margin requirement. Okay, so for example, when you're trading the SIMSCI versus when you're trading into, for example, the US indexes, the margin requirement will be different. So different exchange would come up with different margin requirement. So the clearing house, which is the broker that you're trading with, right, they will usually have this long list of margin requirement. All right, then you just have to track through, right, this particular instrument that you want. What's the margin requirement? There will be this initial margin, all right, which is the minimum amount that is required to enter a new position. Okay, so this is the minimum hurdle, minimum margin that you need to have. Okay, now, however, as you trade, right, there will be this maintenance margin, and especially important when you leave your position overnight. This maintenance margin means that when a position moves against you, all right, and if you hit into a loss, okay, so this amount of money that you have in your account, all right, it must be above the maintenance margin. Okay, otherwise that will result in a margin call. So you have to top up, all right, your margin, all right, top up the amount of money that you have, right, by funding more money, so that you will be brought up to that level of the initial margin. All right, so the margin will be reviewed on a regular basis, and I will touch about that later. Therefore, if you take a look into futures trading, all right, so a lot of people do it for short term, all right, and a lot of people actually use it, all right, as a hedge of the stock portfolio. Because why? Take a look at, think about, you have a portfolio of 100,000, for example, and long term you're bullish, but there will be these ups and downs that you will always see in terms of price movement. So what happened is that you don't want to sell all your stock holdings. All right, what you can do is you can go and use the futures to hedge. The benefit will be, number one, that if you were to use the futures contract to hedge, all right, you won't be penalized, because then you can just easily go short, okay, to sell. Second is that you're using a fraction of your costs. Okay, so for example, 100,000, you don't need to use 100,000 to hedge. All right, you use a fraction of the cost, okay, to hedge using the futures contract. All right, now therefore, to understand into the futures contract, we also need to know about the notional value of the contract. So how do you calculate that notional value? It will be the contract multiplier times the futures price. I will talk about that when we talk about more into the hedging method later on. Okay, now this is something which is important, all right, and that's important for your maintenance margin. Mark to market. Now, mark to market is not something that's bombastic, but it just means that at the end of a trading day, all right, your daily settlement price for the futures will be the same for everyone. Okay, whether you are a huge player or you are just an individual trader, retail traders, right? That daily settlement price, all right, will be the same for everyone, and that's being set by the exchange. So once the exchange come out with the daily settlement price, the clearing house will be able to calculate that profit and loss, okay, that you're gonna have in your particular position if you're gonna hold that overnight. That profit and loss, all right, will be used to offset, right? So you don't lose and you don't carry any losses the next day. But more important, it's going to use to determine whether your current position falls below the maintenance margin. Now, if it does, then you will get a margin call and you need to top up the margin. Okay. Wow, this sounds scary because then you say, hey, look, I'm gonna get margin call every night. No, don't worry about that, because most of the clearing house would actually requires you to give a slightly higher required maintenance margin. Okay, they will set that benchmark higher than what the exchange required. All right, so you don't really get margin call that easily. All right, there must be a hurdle to clear. So again, I don't recommend you to put your margin so tight. Do give a bit of a buffer in case that you fall to the maintenance margin. And one of the questions will be that, hey, if I get margin call and I don't top up immediately, does my position get closed immediately? All right, well, for my experience, no. They will usually call you, they will usually send an email to you and let you know and give you plenty of time to actually top up your margin, unless that your position is really too far away, all right, or too deep down into the losses. Okay. All right, now the futures expiry and rollover, I will use that for the SIMSCI example from the SIMSCI. The last trading day, which is LTD, is the last day that you can trade that particular contract. Okay, now the expiry, all right, date would be the day after the last trading day. Okay, now the question will always be, hey, look, what if I forget that I have a futures contract on hand, and what if that it expire? What happened? Okay, let's talk about the best case scenario. You remember, and towards the end of the month, right, you start to observe that the volume is winding down. It's slowly, not that much volume coming in to trade that particular futures contract. Now, what you can do is that you can offset your position. Now, what is the meaning of offset? If you are long, you buy, right? If you are long a contract, to offset means you just have to sell. Okay, now you sell, for example, you long a September contract, and when it's near to the expiry, you just have to close that position by selling it. Okay, so that's called offset, and you move to the next month. Or what happened is that if you are deep in profit and you think that it can continue to move into profit, but your current month contract is going to expire, so you can do a rollover. Rollover means that you offset your current position and you establish a new position in the next contract month. So for example, I close the current month. All right, now the next moment I will open another contract, all right, of the same direction in the next month. Okay, so for example, I will close the September contract, open an October contract. All right, both of them, they are long. Okay, now otherwise, if you happen not to remember that you have a futures contract going on, all right, then you will move towards settlement, and it will be cash settlement, meaning that the contract will expire, the trader will go into settlement, and they will calculate, for example, whether you are in profit or loss. Okay, if it's loss, they will deduct from your account. If it's profit, then they will put money into your account. Okay, so that's something not to be worried if it's expired. All right, now we talk about volume. Volume would be, as what we understand from equities trading, the number of contracts, or rather the number of shares, okay, but in this case it's number of contracts that have been bought or sold over a given period of time, okay. However, the understanding of volume in our context, which is trading the futures, that's a little bit different, okay. Now in the volume for the futures contract, all right, it is good to know volume, especially when it's moving or approaching the month end, meaning that towards the month end, towards the LTD, which is the last trading day, you start to see and observe that the volume being traded in the current month starts to wind down, start to decline in the number of transactions. Okay, now that's because that some people are moving to the next month already, so they stop trading the September contract, they are moving to October contract. Okay, so you can use the volume as an indication to know, for example, when you should be moving to the next month, right? And usually the volume, or rather it will be more active if the cash index is trading, meaning that, for example, when STI is trading from 9 to 5, all right, then that would be the period where you start to see more contracts trading into the SIMSCI. That's partly because of our behavior, because then that's when we are working, okay. But the good thing is also that the futures can be traded off cash index trading hours. So I will talk about that. Okay, thus, all right, a spike in volume doesn't mean that the buyers are strong and active. It's just different from, all right, equities investment or trading. Okay, a spike in volume doesn't mean that you can say, hey, look, I want to go and buy now. Okay, so that's different. All right, now more important of understanding the futures contract is to understand, instead of volume, but the concept of open interest. Okay, so what's open interest? As the number of contracts held by market participants at the end of the trading day. Now let me just give you an example here, right? I have this lady here, all right. What she did is that in this particular trading day, she bought 5 contracts, all right. And then this man here, he also bought 10 contracts. Okay, so we have like 15 contracts, right? Then this another lady, she sold 10 contracts. Okay, so therefore, what's the open interest here? The open interest is actually 25 contracts. Okay, it's not like 5 plus 10 minus 10. No, all right. The total contracts that's being held by them at the end of the day, that will be 25. Okay, however, if this lady decided to close, okay, she bought, right? So how did she close? She can sell her 5 contracts, so she closed, all right, the 5 contract. So thus the open interest right now will be 20 contracts. Okay, now what is the meaning of open interest, and why are we interested in open interest? That's because it gives us an idea of market liquidity. All right, it means that if you start to see the open interest getting higher, it means that the more money are flowing into the futures contract. Okay, futures market. All right, when the open interest decline, then money is moving out. Now when you have the open interest data, or when you start to see, for example, the open interest is increasing, it says that the trend is strong. All right, why is that so? Remember, we have this huge drop in February and March, for example. All right, then that was a very determined drop, a fast and quick one. All right, if you start to see, for example, open interest, right, coming in at the start of the month in February and into the futures market, it means that if ever price is to move down, all right, then that particular trend will be very strong, because that's when money is flowing into the market, into the futures market. Okay, now when for example it's in a deep downtrend, however, in the futures contract you start to see, for example, is a declining open interest, then perhaps that this is also a clue to let you know that that trend is slowing down, is losing its strength. Okay, so this is the benefit of open interest.